Good evening to one and all present CEO Dr. Mohit Batra. You can drop in your queries on any of your financial or investment related.
The expert reaction is typically an outcome of data presentation, as I've always seen. And data presentation is always dependent on how the data looks at that point in time. If you look at today's data and if you look at where the global data is and where the local Indian data is, I think for the first time over the last 3 to 4 quarters, I personally feel that the Indian data is coming under pressure. Now, if you were to look at the reasons behind that, the reasons were obvious. The reasons was, it's not that we were not aware of these reasons. These reasons obviously were in the process of building up, but we personally believed that the intervention on the interest rate hikes would typically slow down or halt at least, if not reverse. Now, if you look at the 4 main things that are happening in the Indian economy, let's look at the episode number 1, which is the inflation versus growth story. We have seen historically, and this is not just a matter of seeing it, this is a matter of pure, simple macroeconomic analysis, that if you keep increasing the interest rates, at a certain point, the growth starts getting affected. If you keep taming the inflation, at a certain point, the growth will get impacted. And I think there is that whole stretchability to which you can increase the interest rates, you can try and tame the inflation, but one should not forget that that comes at a compromise of growth, which is going to start reflecting in the current quarter, because primarily if you see the growth numbers of the forecast of the companies as well as overall economy will start getting impacted. Now, this is a very, very difficult situation for central banks to manage. To demystify this whole concept, let's look at a certain number. We had projected a nominal GDP growth rate of around, say, 10.5% in this particular year. The real GDP number is nominal minus the inflation number. Now, if you are looking at the current inflation numbers in India, that is around 6.4%. The RBI's expected inflation numbers is in between 4 to 6%. So that means that you need a real GDP growth rate of around 5%, in that range, 5 to 5.5%, if you were to look at, or maybe 4.5 to 5% if you were to look at, to control inflation and deliver the nominal GDP number of 10.5%. You try and control the inflation, or you try and grow the economy, or you try and do both. It is a very, very fine balance, and I think at a certain point this balance starts getting impacted, which is what we are seeing today. We have increased with this 25 bips, which is maybe coming in tomorrow in the monetary policy. RBI would have, over the last 1 year, would have increased the interest rates by around 2.65% in total, which basically means that we have given in enough to things like currency impact, to things like global economy slowdown, to things like exports slowing down, all of those factors to try and manage our inflation. But having said that, inflation per se was not an Indian problem. Inflation was not an Indian problem. When the inflation in US and the European countries busted up, inflation in India was not a serious problem. Reaction to that problem, reaction to the global inflation problem is where we have acted upon, and we have reached where maybe tomorrow we would be at a 2.65% interest rate hike over the duration of the last 1 year. I personally believe that anything more than this will seriously impact growth. Anything more than this will seriously impact growth. And looking at where our government works at and looking at where the elections are, I personally feel that at a certain stage, the reversal of this interest rates is very imminent in the next 3 to 4 months. Now, as I said, this is my contra view. This is not the market view. I think 99.99% of the experts in the market don't believe in this, but I personally feel that looking at factors of not to sacrifice growth, looking at factors of making sure the equity investments are delivered back on higher returns, making sure that the corporate results and the corporate commentary is good, making sure that the budget around the corner, the elections around the corner are, to an extent in a positive note. I personally believe that there is sooner or later RBI would have to look at either halting or reversing the interest rate hikes. This is also pertaining to the base fact that inflation is not a real issue in a country like India. We were running at a 7.5%. Today we are at a 6.4%. So it's not that, we are in a phase that there is a direct correlation of increasing interest rates and depleting the inflation. It happens over a longish period of time. The results happen on a longish period of time. So that is something that is bound to happen. I personally feel that as Government of India and as Reserve Bank of India, I think a fine balance is very round the corner, and I personally believe that it would go in favor of growth rather than go in favor of inflation, which is actually not a real issue. Interest rate hikes have happened to manage global reactions to what is happening across the world, which was imminent, but I think beyond a point in time, government will have to look at growth as numbers, because this is the first quarter where I see growth numbers not looking very good. The second is the March commentary. Now, obviously, as you know, that we are expecting the March commentary to start off the corporates very soon, and I think some of the corporates have started talking about it. Maruti came out with a prediction of 4 to 5% growth versus 11% growth. There are certain, Mahindra and Mahindra came out and said that it is not visible. So people are talking about visibility of growth because everybody is on the ground not looking at what their output and growth would be, but what the environment which is external to them, how that would respond and how they will respond to the growth. So it becomes very difficult to try and ascertain your personal growth at these times. The third, which I call as the market cap to GDP ratio, an excellent factor to look at. If you look at FY22, we were at around 112, 115 odd percent. If you look at last year, we ended up at around 95 odd percent, which basically means that the equity markets after a long time are undervalued, which favors reward. So anything that happens good from here will get lapped on by the markets because we are already in a better valuation situation. We are in a position of undervalue today as compared to historical averages, as compared to even the year before. So that is a very interesting fact to take home as one of the positives in the market. Having said that, the whole fine equation in between inflation and your growth factor has to be taken into account as number one worry. Joker in the pack, as always, is the monsoon. We've had early rainfall, erratic rainfall, with which we are looking at the impact on the Rabi crop. We have latest numbers that will come out by the mid of this particular month on how the monsoons can act up, and I think that is a joker in the pack. Impact on rural economy, agriculture economy typically has a 15% share on the overall economy. Rural economy has around 40% share on the overall economy, so that can be a sizable impact if we are not at least at 80-90% on the projected rainfall estimates. So this is a very important thing, but I personally believe that there is a last cycle that is going on in India, which is at least of trying to tame inflation at the sacrifice of growth. And I think very soon the government is going to do something about it, or maybe able to turn that whole piece around by at least halting or, reducing the interest rates. So that is my personal contra view. With that note, let us open the dais for Q&As and let's address individual questions as you may have.
Okay, starting off this question by Prasad. Considering El-Nino, inflation and election, all these together will have greater impact on equity And hence, gold is one safe investment for 1 or 2 years. What's your call on this?
I personally feel that the answer may be yes. I think gold will, gold is already at an all-time high. So it is not that it is a turnaround story. I personally feel that the commodity cycles will play out very well, select commodity cycle, and gold will be a big beneficiary out of where the equity market instability is today. And I think the volatility in the equity markets may continue in this particular year. It will be a bottoms-up market, which means that everything will depend on how strong your stock selection is. And I personally feel that I may tend to agree with you, not fully, but I think most of me would agree with you that gold is looking at a good opportunity in this particular year.
Okay, moving to this next question. This is by Sumit. Good evening, Dr. Mohit. I am a new investor and my goal is to invest for a longer term, more than 10 years. Should I invest in stocks or mutual funds or both?
If you're a long-term investor and your investment goal is over a 10-year period, I think I would completely and give you a 100% frank answer that you should be investing in stocks, not in mutual funds. If you can be involved and you are ready to take the volatility of the equity markets, then I think you should be looking at direct stocks investing through a portfolio approach rather than a rather than a mutual fund approach, because I personally feel that sooner or later, looking at the size of the funds, and we've been looking at a lot of analysis of mutual funds nowadays as well, you will get index returns. Investing in mutual funds for me is primarily index investing. Sooner or later, you would see somebody will outperform, underperform, but you will, index gives you the best returns out there. And if you're looking at index plus kind of returns, the vehicle becomes a direct equity portfolio investing.
Okay, moving on, this next question by Mr. Balasundaramradhakrishnan, and I think you addressed this, Mohit. He says, good to have you back. Can you update on the PMS launch? Is it on track for launch on 1st May?
I think, sir, 1st May looks a little difficult, but I think somewhere in May, we should be able to launch it. I would say that it would not go in June. It may not happen on 1st of May, but somewhere in the month of May, we would be able to launch it. There's a lot of external party dependencies. We have to sign with the custodials, brokers, software providers, and so on and so forth. All of that is going on. But a slip can happen in between the cup and the lips. So I personally feel that in the month of May, it will happen. I can't commit on 1st of May, but definitely in the month of May.
Okay, this question by Tapan. Good evening. Nowadays, many stocks appear and disappear frequently in the Mojo stock list. You had told in the previous webinar that before the stock enters, it should be in the fridge to check certain parameters. And if satisfied, then only the stock shall be released. But in reality, it's not happening. Any cause behind this?
No, Tapan, actually we are doing that. The only thing that I think what we're doing is we are making sure that the entry on the stocks is correct. So basically, see, what happens is that the objective was not just to reduce the churn of Mojo stocks which was happening, but also to make sure that we make stocks as Mojo stocks which pass certain criteria before they get into the Mojo stock list. So, I look at certain daily return trends. I look at whether it is outperforming the benchmark on a continuous basis before we put it into the Mojo stock list. Once the stock comes in the Mojo stock list, there can be something awkward that can happen with the market and they may get out. So sometimes the stock goes out in a week or 2 weeks time. But those are not, that's not the rule. That is maybe an exception out there. If you look at, the Mojo stock page and you look at all the stocks out there which are currently live and which have gone out, I personally feel 80% of the stocks and plus have stayed for over a month and 2 months. There are stocks which have gone out in a lesser period of time. I agree with you, Tapan, but also look at the volatility in the market. When you have this kind of a volatile markets, there are sometimes, 10-15% of the stocks that move in and out very fast. Inward, how a stock is selected and declared as a Mojo stock has become very stringent. It can still move out. So that is the piece which makes the stock list a little volatile, but I think that's a matter of time which will get sorted out.
Okay, moving to this next question by Mr. Praful. Hello Mohit Sir, good to see you after a long time and hope you're doing well. Is active profit booking a strategy for this market cycle? And do you see, will it change in good times? I've recently seen that after profit booking, the exited stocks have also surged a lot. Are we not cutting the good stocks early?
Hi Praful, how are you doing? Thank you so much for your wishes. The active stock booking is a pertinent strategy for these markets. Is a pertinent strategy, and I think, as per our analysis, most of the stocks, and again I'm saying a stipulated number, but I can give this to you, on an email as well, that when we've exited a stock, most of these stocks have typically gone down. I'll give you a simple example. There's one stock in my portfolio which was Mahindra CIE, for example, right? It had hit a 33% gain, and I was in the US, and it came to me as a sell. I couldn't transact for almost a week, and the stock came down from a 32% profit to a 18% profit to me. We've seen profit booking work beautifully well. There may be cases where the stock has moved up, but majority of the cases wherever we've done profit booking, and I can, as I said, I can emphasize that with everything that we've done, all the profit bookings that we've done, and analyze and show it to you. But with whatever profit booking that we've done, most of the time the stocks have gone down. That has been our personal experience. We have been extremely happy. In fact, I check stock by stock. इस स्टॉक पे हुआ, इस स्टॉक पे हुआ, इसका क्या प्राइस है, इसका क्या प्राइस है. We do that exercise almost on a weekly basis to try and see that, when we've gotten out, are we getting the exits right? Because, in the last 1 year, that whole discussion that we had is a stock goes up and then comes down, and we are not able to capture the exit at the right time. And I think I'm very proud to say that most of the time we are catching the exit at the right time nowadays. Is profit booking a strategy for all times, or is profit booking a strategy for certain times? I think that is a very pertinent question that you asked, and I personally feel that profit booking is a strategy for certain times. It is not a strategy for all times, which basically means that in volatile times, in uncertain times, you would like to keep locking in certain profits from your buying, right? In that time, I should not be looking at whether I booked in a 30-40% profit. Now, some stocks have gone down to 20%, 10%, or sometimes the stocks have gone to 40% up. That was not the objective. Objective was keep locking in and moving to the next stock. Keep locking in and moving to the next stock, because you're making sure that you're conserving. It is known as a con-grow model, which is you conserve and grow. You conserve and grow. You keep conserving and growing. But that strategy works in volatile times, in a flattish market, in bearish market. It works on both the market cycles. When the market gets into a bullish zone, at that time, there are two options. One is that you remove the profit booking or you increase the triggers. To give you an example, this is just an example. If I make 30-35% on a stock, I will book profit. Now, this may be my flat market and bear market philosophy. In a bull market, I can take that 35% to a 70%. Or I can remove it altogether and let the stock go out naturally out there. So your either triggers go much higher of execution of profit booking, or you don't deploy profit booking at all. I personally believe that भागते हुए घोड़े को रोकना नहीं चाहिए. Right? And that is the reason that in bull market, you should never apply a profit booking strategy unless your triggers are very high. Let me tell you how we've applied profit booking. So we've applied profit booking as a mix of all three market scenarios, right? As a mix of flat market, bear market, and bull market. I'll tell you what we did. What we did is that we kept a nominal trigger. For example, again, I'm giving you an example. Don't take this as hard numbers, please. Disclaimer. Let's assume that I say I will do profit booking at 30%. But we don't do profit booking at 30%. Right? If the stock comes at 30%, we wait. If it is going up, I don't do profit booking. If the trend reverses, so let's assume it goes to 40%. I've still not profit booked. My trigger was 30%. If the trend reverses, let's assume from 40% it comes back to 35%, I will do it. So I will end up doing two things. One is cutting the stock only when it has a negative trend, and B is earning more than 30%. then I have another trigger, say a 60%, 70% trigger. If the stock touches a 60, 70%, then I have a larger trigger that, okay, now I've earned 60, 70%. If it falls more, I will cut it. But if it is going up, I'll let it go up. So we have done a model which actually can work even in bull market, even in flat market, and even in bear market. And that is what we've implemented on all the portfolios.
Okay, going to this next particular question. This is by Kishan. He says, why don't we have trading ET stocks with all 4 green dots? I've seen trading ET suggested weekly or monthly stocks are also strong sell.
So trading ET has got nothing to do with the green dots, Kishan, because it is typically a daily and a weekly or a weekly and a monthly trading call platform. Even if there is a sell stock and there is a momentum, we will look at that. Even if there is a strong buy stock and there is no momentum, we may not look at it. So it is across the market, across the stocks, we just look at the short-term gains possibility of a particular stock, not the long-term gains, where Markets Mojo obviously only looks at the long-term gains. And hence we don't mix these two models up that we will only look at that. Only thing that we look at is that our system tries to say that where is the maximum probability of the return. So even if it is a strong sell stock and it is going up, our system looks at a probability number. And actually that number we also display to you on the site, that the probability of this call according to the system is so much and the probability of the other call according to the system is so much. So we look at a probability of success as a parameter rather than the quality of the stock or rather than anything, because ultimately it's a trading stock. Your objective of investing, your objective of trading are very different, and we should not get confused in that.
Okay, moving to this next question. This is by Vishal. Hi Mohit, I'm having an account with HDFC Securities. I want to know, can I buy and sell the mutual funds through Markets Mojo website after submitting a KYC at Markets Mojo?
Absolutely, Vishal, you can do that. Absolutely, you can do that.
Okay. Moving to this next question. This is by Sandesh. Mohit Sir, it is said that when others are fearful, one should be greedy. Hence, should we continue to buy stocks now?
I can only tell you with my example, Sandesh, that I am buying. And I will keep buying because I think my philosophy is very simple. I think, you have gone through 1.5 years of pain, and once you've gone through 1.5 years of pain, and frankly speaking, the portfolios have not cracked that much. Maybe you've cracked 20%, maybe 5%, maybe somebody is 5% up, somebody is 20% up. So the story is not cracked, but look at the amount of events we've crossed. So look at the amount of events we've crossed. We've crossed a 4.5% interest rate hike by the Feds. We've crossed a 2.65% interest rate hike by RBI. We've crossed, a war. We've crossed the whole of last year under various circumstances, right? We've crossed everything. Now, if we have crossed everything, I think that now there is when people are saying that there is a lack of visibility, right? Most of the people on economy are saying there is a lack of visibility. I personally feel that the lack of visibility is basically tiredness of your eyes, right? It is because you're terribly tired because you've been in the market for 16, 17, 18 months and the market is not going anywhere. And you see and you're tired and you feel that now I don't know what to happen because there's another factor that has come, which is now growth factors, right? So I think it is a fag end, maybe 3 months, 6 months here or there. It is a fag end of the market that is coming in. But as I said, if you keep your approach as a stock approach, making sure that you're picking up high quality, high conviction stocks only, you become stricter in your stock selection, right? Even if the market goes down, even if the stocks go down, when the market turns, you would be the fastest turnaround. So you cannot time the market. That's a base assumption and the base reality that you and me know. The only thing that we can do is stay invested because I don't know when the markets will turn around, and at that time I will not have either the inclination or the belief in the market. Why inclination and belief won't be there? Inclination will not be there because first you will not believe. There's everything that happens is first thing that comes is a disbelief, right? Markets go up 5%, you say, "Ito ho gaya se." Disbelief. So then there is a disbelief that comes in. Then sinking of reality comes in. Right? When the market goes another 10%, you will say, I think the trend has reversed. By the time the disbelief and sinking of reality go away, your time goes away. So in a continuous portfolio, what happens is that situation gives you the benefit. Whether today or tomorrow or after 3 months, 6 months, gives you the benefit. And that is the reason the one simple principle we need to learn to follow is stay invested. Stay invested, because up to 20 to 25% return, you will lose out. And suddenly when the market goes to 20-25% return, what will you say? It is expensive. This is not the time, because already gone up 20-25% so fast over the last 1 month, 2 months and all this stuff. So I follow a standard rule. I am invested. Right? I am invested. My stock selection criteria becomes tighter and tighter. But you have to stay invested. You have to be in the game. You have to be always in the game for that turnaround to happen. You will be. No human being has been able to time it. No system has been able to time it. The only answer to this is a linear line of stay invested. Keep hiking your criteria of selection of stocks in difficult times. And in bull times, go down a little quality, because it doesn't matter, because sab kuch chalega us time.
Okay, moving to this next particular question. Yeah, this is actually by Jigar, and a number of investors asking this. Sir, any offers or discount we can expect in the coming few days to renew our subscription?
Yes, Jigar, we are coming out with a scheme in the next, it's a new financial year, so we want to come out with something to offer to our customers. Just give us a couple of days, we will definitely launch soon.
Okay, moving on, Mr. SAP has actually challenged me to pick this particular question. I don't mind picking it up. He says, whatever is the strategy, the ultimate aim is to make money. Is there any experiment going on with the portfolio here?
No, there is no experiment going on. We've done a lot of experiments with the portfolios. We've done a lot of corrections, and I think every time that we've done a correction and we've deployed something, I have personally come and briefed you that this is what we have done. We are not doing any experimentation with the portfolios. I think the more you mess with it, the more mess you will make out of it. If you are strong in your principle and value system of how you are picking stocks, if you're strong in your principles of how you do loss booking, how you do profit booking, how you're streamlining the stock picking approach and making it more and more stricter, which is all that we did, which is profit booking, loss booking, making the selection more stricter, making sure that our PAS score is different, our portfolio scores are different, they don't get leaked out in the market and everybody's buying it in their personal portfolio. So we've done all of that. I don't think so we're doing any more experiments out there. I think we are very, very solidly sitting for a turnaround.
Okay, this next question by Mr. Kiritkumar. What's your view on the market for the rest of the year 2023?
I think the next quarter, the market would be a little choppy. I would say that it can be maybe 2, 3, 4% here or there. I can't say down or up, but it will be in that particular range. I'm personally very bullish from July, August onwards. And I think the market may end up this particular year in handsome teens on the positive side.
Okay, moving to this next particular question. This is by Mr. Gopal. Hi Mohit, I want to know how can you suggest an entry point for a stock which has grown very fast over a short period of time. For a new buyer, there is a high chance of correction after buying such a stock.
Yeah, so that is always there. If the stock has grown too fast, too soon, you always get into that, fear that the stock may come down. But fundamentally, if the stock is strong and if the stock has gone up, say 10-15%, I typically don't worry, because 10-15% is nowadays a 3-day movement, 4-day movement on the stock. So that is not something that I would worry. There are stocks that still delivers decent returns after they go up 10-15%. In fact, if you look at the time that I used to do multi-bagger series, I used to look at a strategy where we would pick up stocks in the 2-month period, provided they have gone up 20%. Because as soon as the stock goes up 20%, the identification of the stock happens much faster. The positive return attracts positive returns. A lot of investors start looking at that stock seriously, and there is a ripple effect of movement of that particular stock. So what I have seen is that, a 20% kind of a marker on a stock in a 2 month of it being identified, if it goes up, the chances of that stock going further up are very high, right? So now the thing is whether we turn onto the greed that we have to catch it right at the beginning, or we say that we are catching the probability of success of this particular stock at the compromise of 15-20%. I would go for the second. I would say, let the stock display the strength. Let me get in not late, but early on at a 15-20% also is fine. And at that point in time, the conviction will drive the stock to another 30-40-50%. And I'm fine with that 30-40-50% return, but I am at least entering with a higher chance of success rather than a lower.
Okay, question by Vaishali. There's a difference in losing versus gaining Mojo stocks. How can we pick the winning ones?
Vaishali, if I had that answer, I would have not put the losing stocks out there. So there is unfortunately not much of an answer that is there. And only thing that I told you, I told the previous investor as well, is that we've seen that if you deploy a formula where the stock is already 10-15% up and spend some time in the Mojo list, say 1 month for that matter, or maybe 15 days, and it is up say 5-10%, the chances of that stock going up are way higher than a stock which has been added and is slightly negative, or it is 1-2% up. I think those stocks typically take a lot of time to move around. I would typically, for my personal satisfaction, what I do is that I look at a 1 month trigger. 0 to 1 month, the stock got added. If you look at the Mojo stock page, as you do maybe almost on a daily basis, but if you say 0 to 30-day period and the stock is up 5%, 7%, 10%, I typically put that in the watch list, and you would start making your own formula. My formula is up to 15% in 0 to 30 days. I think the success rate of that particular stock almost goes closer to, to affirmative.
Okay, next question by Mr. Sanjay is really straightforward. He's asked mutual fund portfolio not yet launched, and when is the plan?
Mutual fund portfolio is taking time. We are, although if you see that, Sanjay, we've kept buckets out there. We've given three buckets of all the market caps, all the different categories of mutual funds. But we are doing an analysis of what is the best strategy to do a mutual fund portfolio out there. I personally feel that we should be able to do that somewhere in the month of May, not this month.
Okay, this next question by Ripudaman Singh. My Infinity has been close to -11 to -12.5 for the past few months. I haven't been looking at it, but this loss is certainly deeply worrying for me. I'm staying put, but should I expect this to turn positive anytime soon, given the ongoing volatility?
Absolutely. Absolutely. I think that is not... see, the thing is, your Infinity portfolios, move very fast. I can give you an example. I was in the US and I didn't execute 3 calls. And my portfolio was down. 3 calls I couldn't execute because I was out for a couple of weeks. I came back, I executed, I was in -6%, today I am at +6%. So, these portfolios move very fast, Mr. Singh. So do not look at your 10-11% on the market right now. I personally feel that in maybe 3 to 4 months of time, your portfolio would be up and it will deliver positive returns in this year. So I am certain for most of the portfolios that I'm seeing in terms of sheer strength of the stocks that we are holding out there. Nothing to worry about. You have taken enough pain. Do not give up right now.
Okay, this next question by KRISHNARAJ. My personal portfolio score is 79. The score mentions good. My wife's score is 81 and it's excellent. As you said, you should continue to hold on. Are there any changes required here?
Mr. Ved, I can only tell you once I see the portfolio. If a score is a 79 and 81, that's a very good score. And normally wife's score is always higher than husband's score. But if that score is the score, I'll have to look at your individual portfolio to see. And that's actually very simple. If you look at a sell and a strong sell stock, put that into switcher and see what stock they're recommended. You can move into those stocks or simply do a portfolio optimization out there. And it will tell you exactly what our recommendations would be. It's a very good score, but.
Okay. This question by Shyamsunder. Why does quality and technical trend determination vary so much from one provider to another provider? Is there any alternative to just blindly trust someone, since all are using the same historical data and coming out with different ratings on quality and technical trend?
No. So we were the first ones to come out with the name quality in the market, and a lot of people tried to copy us. And I know that a lot of sites have started carrying that whole parameter. Quality parameter is not an easy parameter to assess. You have a 5-7 year old parameter, you have close to 55 odd factors that we look at. We compare those with the peer group, we compare those with the sector, we compare those with the market, and we compare it on a 1 year basis, 2 year basis, 3 year basis, 4 year basis. There are different weightages that the factors have, there are different weightages that the years have. So it's not a very easy parameter कि company अच्छी है, promoter अच्छा है, corporate governance अच्छा है, तो quality अच्छा हो गया. So that is not the way that we look at it. There is huge amount of science that is involved. Technical parameters are vaguely similar across the market, right? Somebody will look at a MACD, somebody will say I will look at a Dow theory, somebody will say I will look at a Bollinger's, somebody will say I will look at RSI. So, a lot of people are specialists in one specific technical tool. What we do there is that we take all the 7 technicals and we do a backward analysis of what this company's stock price mirrors the most, which technical parameters, and then accordingly the weightages are changed. So there also it is a unique model that we follow out there. We have a very large success rate on our technical standing. So when you go to any stock and say the technical grade change, and you'll know what I'm saying. So that is something that you need to, in fact, I met one investor in Chennai, I must tell you, and he said that I will give you a formula of your own company. And he said that I have been making cracking returns. And according to him, and I don't know, I don't have any way to corroborate that number. But he said, I only look at your buys and strong buys, and I just look at when the stock turns from mildly bullish to bullish, and I buy it. And I deliver over 60-70% of return. So everybody makes their own formula. It is just that we don't want to do that because we are running a advisory business which has to sustain and which has to deliver over a longish period of time. So quality and valuation parameters are overused in the market, and technical parameters overused. Valuation as well. Sorry, you had asked valuation. In valuation also, there is, normally you look at P's, you look at forward P's. Everybody's forward P can be different in terms of their earnings estimates and all of that stuff. People come out with different earnings estimate. The difference that we do is that we look at the PE growth, we look at counterparty PE growth in terms of peer group again, and we look at certain balance sheet factors which are sometimes missed on by various other providers. Valuation is also a very misnamed term, I would say, because valuation आपको लगता है कि stock का value कैसा है, अभी सस्ता है, महंगा है, and all this stuff, but you don't look at what kind of a earning forecast it can deliver, and valuation is a changing parameter as well. So all of these parameters are not similar across. You have to carefully select what you're looking at and then invest.
Okay, this next question by Tushar. Hi Mohit, your opinion on IPOs. Should we go ahead with them in the current market?
IPOs in the current market, I would say no. Stay away from the IPOs in the current market. I think the valuations, most of the smarter guys are not coming out with the IPO because they know what the market situation is. So, people who are still coming out with the IPOs, you have to be very clear whether it is an IPO or an offer for sale. Because private equity environment is getting terribly crunched. So private equity environment being crunched may force a promoter to come out with an IPO at a certain point in time, but I don't think so. As investor, we should be looking at it. Your IPO history over the last 1 year tells you what has happened. Why would you like to look at that particular set of IPOs now when let the IPO come out, let the price stabilize, and then invest? And I have never been a fan of an IPO investing thing. I think it is mostly people subscribe to IPO for quick gains. It is not a fundamentally sound model to look at. I think you should stay away from IPOs in the current market scenario.
Okay, next question. This is by Elias. Mohit, when we pick one stock, you all don't suggest downward averaging. But if the stock is still buy, why can't we simply average it?
See, the stock is, if the stock is a buy, that means that you can buy, right? And if you're buying on the dips, then that's fine if you have conviction in the stock. The concept of downward averaging is that you are purposely putting a formula, jab bhi girega main kharidunga isko, right? And those are the things that we typically feel that if the stock, see, we are mere mortal humans. The only thing that we can do is that give you a good call. Now, there is a lot of market factors that can affect the price of that particular good call, right? So it can go down, keep going down and all. If the market is dropping the price of that particular stock, despite of it being fundamentally good or bad stock, right? You are saying that there is something the market knows that I don't know. At a certain stage, you need to sit out and let the market play out. So, if you have a 2%, 3%, 4% correction, that's fine. That's not downward averaging. Downward averaging is the stock fell 5-10%, I bought more. Then it fell another 10%, I bought more. That is something which we tell you not to do. Buying 3, 4, 5% cheaper a stock is always welcome, more than welcome. Even I look at it, right? It's a good stock. Let me just look at it if that is the thing. But having a strategy around only buying stocks, good stocks which are falling consistently, don't fall for that because that may not end up nicely.
Okay, this next question by Uday Raj. Mohit, do you have any preference for certain business houses where we can invest blindly?
See, I like certain business houses. Whether they will deliver returns or not is another question altogether. You're in the process of, or you're in the business of making money. If you're in the business of making money, I would go with the business houses that deliver the growth numbers to me. There are huge amount of business houses that have terrible amount of respect. You have a Mahindra, you have a HDFC, you have a Tata Group, you have enough number of ethical, very high corporate governance, very strong quality, companies that you would like to leave behind for your children, right? Whether they'll deliver return or not is another thing. So if you have to say that whether I'm only chasing names or I'm chasing names with, good return opportunities. And that's where the whole diagram changes. That's where the whole picture changes, the collage changes. You would still look at great companies, right? You will still look at safest possible companies, but you will also look at whether they're delivering growth and numbers to you, whether they're delivering ROI to you, when you invest money, because that's your prime reason. Apne ko trophy to lena nahi hai. We don't want trophies out there. We want working horses, and these horses have to change during a period of time. But having said that, in none of this should you ever look at a bad quality stock. And I'll tell you something that up market mein, wherever you go, whether my calls for certain time don't work or they work, the only thing I can tell you is that once I put the quality number, it's an absolutely genuine quality number. Now, whether the market rewards it or doesn't reward it, it's a very different thing because short term mein kuch bhi ho sakta hai. Long term mein, the price has to follow the fundamentals. There is no two options about it. If you are picking up the strongest possible fundamental company, if you are picking up a high conviction idea, if you are picking up a company that is Q&Q growing, if you are picking up a company that has decent valuation, if you are picking up a company that has high technical score, why will it not go up? The only reason being adverse market scenario or something that the market knows that I don't know, or something that the market knows which is so futuristic that I have no clue, but that futuristic approach carries the risk. So even if you look at, just go to the screener on the site, just look at excellent quality companies and you will see the names that will come out, not just large caps, but even the small caps. Because we forget the story that, Apple went public when Steve Jobs was in the garage. So the small cap companies will be tomorrow's mid caps. The mid caps will be tomorrow's large caps. The large caps will be tomorrow's mega caps. Today, if I have to leave back a company for my children, I would not leave back a mega cap. I would leave back a very solid small or a mid cap, high quality, high conviction idea so that by the time they are able to manage that money, that should have become a large cap or a mega cap. That has been the story of money making across. जो दिखता है वो आजकल नहीं बिकता है, जो नहीं दिख रहा है. And you've got a beautiful platform in Markets Mojo where you have the capability of going down to every single stock and figuring out what's happening. Right? So that is, बहुत लंबा खींच दिया मैंने आंसर को आपको, लेकिन that is my comfort level.
Okay, moving on to this next question by Avnish. I have full faith in the Markets Mojo IP and the question is just for academic interest. When Mojo stocks are decided, there is a human element or an investment committee. However, when backtesting IP for portfolio returns, how the Mojo stock selection process have been applied? Can we compare the backtesting versus front testing results for the last 5 years?
Sorry, can you read the question again?
Yeah, I'll just flash it on the screen as well. He says that when the Mojo stocks are decided, there is a human element. But when we backtest the IP for portfolio returns, how can we apply that human element in the previous years?
No. The human the human impact of selecting a Mojo stock by the investment committee. We don't get into the business case. We look at the corporate governance. We look at broadly the company is fine, right? If the company is moved too fast, if there's anything that we find fishy in the company, that company is not taken in. There are certain times we delay a company to come in out there. So those are the decisions that the investment committee is taking. Investment committee is not recommending a Mojo stock. The system recommends Mojo stock, the investment committee approves the Mojo stock. So it's not that we are taking a different company and putting it on a Mojo stock. So it becomes very difficult for us to look at what point in time I would have taken what Mojo stock. But having said that, now we have a 3-4 years of history of Mojo stocks. You can go to the total sheet, Avnish, and you can see all the calls that we've taken. And I can tell you, just count the number of calls. If over 80% of the time we've not delivered on Mojo stocks, I would be highly surprised. Just count all the calls and say, what has been the success rate of the Mojo stocks. In fact, go to the current list in these market scenarios and look at all that. The only thing we have to maintain is that let's do a double check on quality and corporate governance of this particular company. Let's do a double check. कुछ सुना तो नहीं news में, कुछ देखा तो नहीं, because certain things the system doesn't catch up, right? If there's a negative news going on the company, system won't catch up. So because it is purely a number driven system. So that is the due diligence that we do, not just on Mojo stocks, we do the due diligence even in the portfolios. When the stock comes into the master, we will say, okay, whether it should come in the master or not. After it comes in the master, which means that we've given a stamp of go ahead from the IC, then it plays on. And then we obviously, if there is something happens after that, we will look at that stock and put it in the grey list and instruct you to get out immediately. But that's how it is done.
Okay, this question, actually the statement by Mohit, Madhav, he says, first time we see Mohit toned down. Should we worry about this? Please give us some hope.
मेरा तो गला दिख रहा है माधव जी. मैं तो मतलब toned down where I am to talking in a very aggressive tone. If you want me to be more aggressive, I'll do it. But soft landing कर रहा हूँ ना. I've come after a long time.
Okay, and this next question by Kaustav, how to handle foreign short sellers like Hindenburg in any of our long-term investment portfolios? Should we also take a line of control or stop loss in these long-term investment tips?
No, I think, see, guys, these things will keep happening. Somebody or other will keep happening. I mean, it is not that the concerns that, people have gotten after these, investment firms, but I think the concerns that they raised were very valid. It's not an invalid concern. We had a concern. We never made this stock as a buy stock in our system. We never took this stock as a Mojo stock because the number bhi concern tha. It was not that there was any other concern. We don't care about who the promoter is unless, there is some corporate governance issue. But we look at our numbers and we look at our long-term performance of numbers. Nahi aa raha tha. So we also had a concern on that. These cases in a growing market, in any market, are bound to happen. I mean, 2 weeks back, if I had told you, or 2 or 3 weeks back, if I had told you that Credit Suisse will fall, would you ever believe? Look at the history, look at the pedigree. Look at the, the net worth, look at the book size of that bank. Right? So there are certain things can happen. You get caught in certain positions, you get caught in certain situations and, you come off from that, right? So these things can happen anywhere. It is not just India. It can happen anywhere. The only thing that happens is that you have to align your exit very nicely. उसके बाद opportunistic नहीं होना उस पे. So for example, if there is a stock where there's some news comes out, you sit on the side. You get out and you sit on the side. And then don't say that now that it has gone down 10%, 40% correction again, now let me get in. Because those corporate governance issues don't disappear in 3 months' time just because the stock is corrected. It is just the valuation has become cheap. Valuation become cheap doesn't mean that the quality is improved. So normally what we see is that abhi to ho gaya jitna hona tha, abhi 40% correction aa gaya, let's buy this now. No, that is wrong, because that doesn't mean that the quality of the stock is improved, right? So don't get into the whole thing of I will buy this stock on dips now because, I think the effect of that negative news is out. I personally feel that negative news out ho gaya, I will keep it out in my grey list for a year or 2 years time till the time they sort out their issues. If it's a good stock, it will come back in my portfolio.
Okay, this question by Mr. DP Monti. Sometime in October, my Infinity portfolio is giving negative returns of 17. You had said that by Jan or Feb it will become positive, but the return is now around minus 29. I hope you are not invested in the Infinity portfolio for erosion, but for appreciation.
Obviously, you've not invested in the Infinity portfolio for erosion. You've invested for appreciation. Mr. Monti, I can look at your portfolio. We've, I think, looked at your portfolio internally as well. The market has not been, YTD Indian markets are down 6%. So if you're looking at why the magic turnaround has not happened, I think it's a story well written out there. But having said that, why don't we look at your portfolio once again and we'll see what we can do on your portfolio. And I hope you've executed all your orders in a disciplined fashion.
Okay, Mr. Mohit, that's it with the Q&A session for today.
All right. So thank you so much. Have a good day ahead. And we are coming out with the stock of the month in this particular week, which will be an interesting parameter. We look forward to the monetary policy, although we know broadly that it would be a 25 basis point increase tomorrow. And we'll see you soon. Thank you so much.
Yeah, thanks for everyone for joining today's event. Goodbye and have a great evening.